Hi everyone, welcome once again to our discussion on market indicators. Friends, in the last video we have seen one of the indicators, that is the advanced decline line. There we have discussed that we have some price movements going on and we want to know whether this momentum will continue or it will take a reversal. If there is an uptrend, will the uptrend continue or there are chances that it will take a reversal. For that we take help of the indicators. Market indicators had always helped the investors in trading profitably. So indicators will tell us, will there be a reversal of the trend? Okay, the momentum will be maintained or there will be a reversal. Now whenever there is something or some variations between how the price movements appears and how the indicators are reflecting. Suppose the price movements goes uptrend, but your momentum indicator, it could be anything, advanced decline line or oscillator or RSI, your indicator shows something different. Then comes the matter of divergence. So there is a divergence. So divergence can be altogether 4 types basically. We will classify the entire divergence into, so I hope you understood what is divergence. Divergence happens when your asset price shows something and when your indicators are also showing the same thing, there is no divergence. But if your asset price movement and your indicator shows something different, as you can see, here to here there is an increase, but here to here there is a decrease. So there is some divergence, and this divergence is something which we as traders should try to identify to make a profitable trading strategy. Let's begin with divergence. So divergence can be of 2 types, regular divergence and the hidden divergence. Now we talk about the regular divergence. It can again be of 2 types. One is the bearish regular divergence, another is the bullish regular divergence. Here divergence again can be a bearish hidden divergence and a bullish hidden divergence. So let's very quickly understand and just the concept of, I will just be able to explain you the concept. So what is a bearish and bullish regular divergence first? Let's understand this one first. So let's understand regular bearish divergence. So let's take a case like this where you see the asset has taken a higher high. Why higher high? See, the higher it has gone higher high. Okay, but you identify at this point of time, you have realized that the indicators has shown a lower high. So you can see here and here the indicator has shown a lower high. So this line is going up, but this line is going down. So this is known as a bearish regular divergence. Why? Because it says that the price indicator shows that the price is going down and the momentum is weakening. Okay, so the momentum is weakening in the sense that the bearish power is gradually diminishing, and I mean to say the bullish power is diminishing and the bearish power is strengthening. Okay, as you can understand, there is a downturn, so it is going to disturb the trend and there is going to be a reversal. So this is known as the bearish, regular divergence. Let's understand the bullish regular divergence. It's just the opposite. Here we will see the lows. You can see I am just trying to help you to understand this. The price has taken a higher high, by indicator has taken a lower high. As you can see, there is a lower high. Let's understand this. Here you can see that the price has taken, I'll just explain it a bit clearly. Suppose the price has taken, the price had taken a lower low. Okay, the price has taken a lower low. As you can see, the price has taken a lower low. But what is happening to the indicator? The indicator is taking a higher low. You can see the indicator has taken a higher low. So then this means that though the price movement is downwards, but there is going to be an uptrend sooner or later, right? So this indicator is diverging. What the price is reflecting and the indicator is reflecting, it is diverging in an upward way, and therefore this is known as the bullish regular divergence, right? So you have, for your simplicity you have, but here it is, okay, so this is higher high as per the price, but it is lower high as per the indicator, and there it is showing lower low, but the indicator is showing higher low. So you can see it is a higher low. Okay, so if you connect, you understand that the lines are opposite. You understand the lines are opposite. So there is a divergence. This is a bearish divergence. This is a bullish divergence. Let's understand hidden divergence. Hidden divergence happens when you find that there is a trend continuation. This is trend reversal. The trend is likely to reverse, but here the trend is likely to continue. So what happens in a bearish hidden divergence? Let us see this first. Okay, in a bearish hidden divergence, the price will take a lower high. The price will take a lower high, okay, but the indicator will take a higher high. The indicator is taking a higher high. Okay, price is taking a lower high, but indicator is taking a higher high. This is called but here what does this indicate? It indicates the price is falling and the downtrend will continue, though the indicator is showing an uptrend. Indicator is showing an uptrend, but the price movement is downwards, and this trend will continue. Why? Because then why it is behaving opposite? This is behaving opposite because the indicator is actually taking care of not just the price change, but it is also taking care of the speed or the strength. Though the strength is weakening, but the price fails to rise, right? Though it is showing that the strength is weakened, the speed at which the price were moving, it has weakened, the momentum is weakened, but the price does not increases, rather it falls. So this is a hidden bearish divergence. Okay, so it is a hidden bearish divergence. Let's see what is the hidden bullish divergence. Hidden bullish divergence happens when the price takes a higher low. Okay, you can see the price has taken a higher low, but the indicator has taken a lower low. As you can see, the indicator has taken a lower low. Okay, the same thing, though the indicator is showing that the momentum has weakened. Okay, the speed at which the price was rising, it has weakened. Okay, or the strength is reducing slowly, but the price fails to fall, rather it is rising. So this divergence is hidden, and this is known as the hidden bullish divergence. So this is a trend continuation. Remember, this will indicate trend continuation. Trend will continue as it is showing, though the indicator speaks something else, but the trend will continue, and this is a trend reversal. The trend will reverse. This is called trend reversal. So friends, with this basic concept, I hope you have at least got an idea about what is divergence and what are its types. Friends, with this understanding of divergence, I think you will be better able to understand that how market indicators like RSI or oscillator can help an investor trade profitably. So thank you for watching. Keep watching the videos that follows after this. We will meet again in a new lecture on some other market indicator. Till then, goodbye.